Tesla has a track record of beating earnings for the past 6 quarters in a row. Can they keep up with that beat in earnings? Hi guys, it's Stock Curry, and earnings across the board beat expectations on Tuesday, sending the stock market higher for Wednesday. Today we're going to talk about what to expect for Tesla earnings after the close and how you can prepare to trade earnings. So let's get into it. Netflix blew earnings out of the water, sending the stock up over 15% after hours. Netflix reported $3.10 versus only $2.13 earnings per share, a 30% higher earnings per share than what was previously forecast. Revenue also came in at $7.93 billion versus $7.83 billion forecast, but the biggest beat was actually their net subscriber growth. They grew subscribers by 2.41 million versus only 1.09 million expected. They more than doubled their expected subscriber growth, and that is why the stock market is skyrocketing after hours. Now, there are a couple of things you should be aware of for Netflix earnings in the future. First of all, they are no longer going to forecast their subscriber growth. They are instead only going to forecast their earnings and revenue. So it's unclear how that might affect Netflix's story as a growth stock if we don't really have anywhere to forecast for subscriber growth. However, it is currently trading at a fair PE ratio, so with the earnings going up by 30% over what was expected, I would not be surprised to see Netflix trading at about a 30% premium to where it closed at on Tuesday. Now, Netflix was only up about 15% after hours, so I could see Netflix rising another 15% from here, even after the after-hours rise on Tuesday. United Airlines also beat earnings expectation and was up by over 7% after hours. United reported earnings per share at $2.81 versus only $2.28 expected. Revenue was also higher at $12.88 billion versus only $12.75 billion expected. And Adobe stock also jumped 3% after hours after they estimated better than expected growth for next year. Adobe is estimating 9% growth next year and said it would be 4% higher if it were not for the strong US dollar. And it is that strong US dollar that has many people concerned about Tesla earnings. Tesla has a track record of beating earnings for the past 6 quarters in a row. Can they keep up with that beat in earnings? It's going to be hard to tell. We don't know what Tesla is going to report. For one, we do know that deliveries are down. We know that orders are down. We know that they've had major supply chain issues in China, and we know that the strong US dollar is hurting them. Keep in mind that as the strength of the US dollar goes up, this really hurts international companies that operate out of the United States because it has the effect of lowering international profits. Yeah, profits in the US are good, but across the world, those profits are down significantly due to the conversion rates of the US dollar. So this really hurts stocks such as Tesla that operate overseas. And we don't know how that's going to affect Tesla's earnings and revenue. We're going to find out after the close. Now, Tesla stock is already down over 30% this year, so surely a lot of these declines have already been priced in. However, the PE ratio on Tesla is still very, very high. It's actually has a forward PE ratio of 50, with the current PE ratio much higher than that, over 80. So Tesla is really going to have a strong earnings if they want to keep that high PE ratio. Netflix was coming off of 2 quarters in a row of declining growth. So for them to have a complete 180 turnaround story, it makes sense for the stock to be up 15% after hours. That is not the case with Tesla. Tesla is coming off of 6 quarters in a row of good earnings. So they're really going to have great earnings with us going into a recession and with Tesla's PE ratio still being quite high if we want to see Tesla stock rise after hours. Now, on a side note, there was one other bit of good news that caused the market to go up a little bit today, and that is the fact that President Biden announced the release of up to 15 million more barrels from the strategic oil reserve. What this has the effect of doing is extending the release of oil through the end of December. Now, don't get me wrong, this is merely a political play. This will have very little effect on the actual price of oil. This is just a political play to look good going into elections. Keep in mind that the United States has its elections in just 2 weeks. And so when the United States has their elections, obviously the party who's currently in power is going to do everything they can to look really, really good. And then after elections, it's basically, okay, we won. Now let's get back to reality. Those strategic petroleum reserves are going to have to get refilled, which means the U.S. is going to have to go out and buy additional extra oil at already high prices. And that's going to have the effect of causing the price of oil to rise next year in 2023 at the same time that OPEC is already cutting production of oil, which is also going to send oil prices higher. What that all means is that inflation is going to come back very strong in 2023. And that is one of the things that has a lot of people concerned that a recession that we're probably already in is going to turn much worse next year. Despite all of these good earnings announcements, it's very important to remember that the stock market as a whole is still fundamentally in a really bad spot. Apple stock actually caused the whole market to drop by about 1% in about 10 minutes when they reported that they were cutting production of their iPhone 14 Plus. This comes just 2 weeks after its debut. This reminds me of a lot of the companies last quarter that reported earnings and gave these great forecasts and then came out 2 weeks later and lowered their forecast guidance. It's really interesting to see this earnings season. We do expect most companies to beat earnings, no doubt about that. But the question is really going to come down to where is the forward guidance? 2022 is the worst year for the stock and bond market since 1969. So far in 2022, both the stock and bond markets have posted serious losses. To find another market that looks like this one, you have to go all the way back to 1969. The S&P 500 is down nearly 24% to date, and the bond index is down nearly 16% to date. If both indexes finished in the red, it would be the first time that has happened since 1969. And looking back at 1969 to see what happened the last time both the stock and bond markets were down significantly, rapid inflation in the mid-1960s forced the Federal Reserve to hike interest rates in an effort to cool the economy, much like what's happening today. That sent the economy into a major recession in 1969, and it marked a year of both negative returns for stocks and bonds. And of course, we're seeing the exact same thing this year with the stock and bond market both down and the U.S. economy already in a technical recession, with most people predicting a significantly major recession next year in 2023. So just more historical analysis to point to the fact that we are in fact going to get a major recession next year, which means stocks and bonds are going to have a very difficult time recovering back to all-time highs anytime soon. Now, the other thing you need to understand about Tesla earnings is the weight that it has in the overall market. Taking a look at the S&P 500 companies by weight, Netflix, which reported Tuesday night, is 60th in weight in the S&P 500, making up only 0.35% of the total index. Tesla, on the other hand, is 5th in weight, making up 1.89% of the total index. And in the NASDAQ 100 weighting, Netflix is 21st in place, making up 1% of the total index. And Tesla is 4th, making up 4% of the total index. So in both the S&P and the NASDAQ, Tesla is 4 times more important than Netflix is. So even though Netflix, United, and all these other companies had great earnings Tuesday after the close, and no doubt sent the stock market up on Wednesday, it could all get wiped out on Thursday, depending upon how Tesla actually does earnings. Now, if Tesla beats earnings, of course, the market's going to go up massively again on Thursday, probably selling off into Friday. But if Tesla misses earnings for the first time in 6 quarters, we could see Tesla fall even more than it already has. And with a 4% weighting in the NASDAQ and a nearly 2% weighting in the S&P, that is going to bring the entire stock market down with it and could very quickly wipe out all of Wednesday's and possibly Tuesday's gains. And as important as Tesla is, it is nothing compared to the top 3 holdings of Apple, Microsoft, and Amazon, which collectively make up 15% of the S&P 500 and a whopping 30% of the NASDAQ. Microsoft reports earnings next week on October 25th, and Amazon reports earnings next week on October 27th. Along with Apple, who also reports earnings on October 27th. So no matter what happens this week, it could all be for nothing compared to what happens next week when 15% of the S&P and 30% of the NASDAQ report earnings in a short 3-day time period. And even those earnings could get wiped out when the Fed meets the week after and raises interest rates again. If this video was helpful for you, be a good friend and share this video with your friends and family and hit the like button and subscribe. And if you want more information on how Tesla might perform during their earnings after the close on Wednesday, make sure you watch the last video that I uploaded here.